Imagine an exclusive financial ecosystem hidden from the public eye, where elite institutions trade secret debt instruments yielding 30% annualized returns with virtually zero risk. For decades, this enticing pitch funneled billions of dollars into shadow accounts worldwide. Promises of extreme wealth hinged on access to a mythic inner circle of global finance. Yet behind the impressive legal paperwork lay an unsettling truth. The entire trading market was a complete illusion. This illusion is known as prime bank fraud, a deceptive financial scheme where promoters claim exclusive access to non-existent trading programs involving top-tier international banks. Perpetrators assure investors that the top 50 global financial institutions secretly trade debt notes among themselves at huge discounts. Investors are told that by pooling their capital, they can purchase these discounted instruments and immediately resell them at full face value, securing massive risk-free profits. The success of the scheme relies heavily on psychological leverage and enforced secrecy. Fraudsters impose strict non-disclosure agreements, convincing targets that discussing the opportunity with traditional financial advisors will violate international banking law or forfeit their allocation. This artificial exclusivity insulates the scam from professional scrutiny while feeding the investor's desire for insider status. Victims genuinely believe they have been granted access to an elite financial mechanism reserved for sovereign wealth funds. The promoters executing these scams are master articulators of financial fiction. They present elaborate contracts filled with dense, impressive terminology, invoking phrases like standby letters of credit, irrevocable bank guarantees, and discounted roll programs. By weaving real financial terms into nonsensical legal frameworks, they build an imposing facade of legitimacy. Their polished demeanors and opulent surroundings project an image of immense institutional authority that disarms initial suspicion. The fallout from these fraudulent offers reaches far beyond overly eager individual investors. Wealthy retirees, municipal funds, and even charitable foundations have transferred life savings into these illusory trading programs. In one prominent case, an entire retirement fund vanished into offshore accounts within weeks. The financial loss is often catastrophic, causing severe personal disruption and destroying community institutions that believed they were securing perpetual funding. Traditional banking networks initially faced significant challenges in detecting these transactions. Because the fraudulent paper existed outside standard clearinghouses, warning flags rarely appeared on internal compliance monitors. Promoters instructed victims to wire funds directly to corporate escrow accounts or attorney trust accounts under the guise of commitment fees. This practice bypassed primary bank oversight, leaving established institutions unaware that their names were being weaponized. The proliferation of these schemes accelerated rapidly during the 1990s as global finance modernized. Rapidly expanding international wire transfers outpaced regulatory coordination, creating blind spots across national borders. Scammers took advantage of this transition, dressing age-old advance fee swindles in modern international banking attire. The rapid digitization of capital allowed fraudulent solicitations to cross oceans instantly, leaving cross-border enforcement struggling to keep pace with overseas wire transfers. Investigating these operations presented monumental obstacles for law enforcement. Victims, bound by non-disclosure agreements and convinced that public disclosure would forfeit their returns, frequently refused to cooperate. When payouts inevitably failed to materialize, promoters blamed bureaucratic delays, regulatory red tape, or minor administrative errors. This manipulative stalling tactic bought perpetrators critical months to transfer funds through complex webs of offshore shell companies. The tide began to turn when isolated complaints coalesced into an undeniable pattern across federal law enforcement agencies. State securities regulators, federal investigators, and foreign financial authorities began exchanging notes on strangely uniform contract language circulating globally. Suspicious transaction reports filed by alert bank tellers highlighted massive domestic wire transfers destined for obscure tax havens, triggering deeper cross-agency inquiries. Many of these operations operated under the umbrella of a high-yield investment program, an unregistered investment vehicle that promises extraordinarily high rates of return while claiming to minimize risk through proprietary trading strategies. While legitimate investment vehicles disclose operational mechanics, these high-yield programs operated entirely in the dark. They used funds from new investors to pay small returns to earlier participants, hiding the complete absence of actual trading. To dismantle these sophisticated fronts, federal investigators called upon expert economists from major central banks. When presented with prime bank guarantee documents, central bank officials confirmed that no such trading market existed or had ever existed. International institutions issued definitive statements confirming that top-tier banks do not trade discounted debt instruments in secret secondary markets. The phantom promises had no basis in real-world finance. Even with the myth debunked, tracing the diverted capital remained a complex puzzle. Fraudsters used layered offshore accounts, moving funds across multiple international jurisdictions within hours. The rapid dispersion of funds exploited jurisdictional friction, forcing authorities to navigate slow international legal treaties to freeze assets before they disappeared into untraceable private investments or luxury assets. A major turning point arrived through decisive SEC regulatory action. The Securities and Exchange Commission published comprehensive public warnings specifically identifying prime bank claims as outright fabrications. The Commission detailed the exact terminology used by fraudsters, arming financial institutions, accountants, and investors with clear criteria to identify these fraudulent solicitations on site. Equipped with clear legal precedents, federal regulators launched aggressive civil enforcement operations. The Commission filed emergency asset freeze actions against major prime bank syndicates, halting operations before remaining assets could be spirited overseas. Courts systematically rejected claims that these instruments were proprietary, ruling that selling fake instruments constitutes blatant financial misrepresentation regardless of the terminology used. For many victims, the regulatory exposure sparked painful psychological shock. Admitting that an elite opportunity was a complete fabrication forced investors to confront not only financial devastation, but also the realization that their insider status was an illusion. The psychological weight of misplaced trust led many to remain in denial, occasionally defending the fraudsters even as court proceedings exposed the fraud. The legal hammer fell hard as civil enforcement turned into criminal prosecution for severe securities fraud, defined as illegal conduct in financial markets that misleads investors through deceptive claims or withheld information. Federal courts handed down lengthy prison sentences to prominent promoters, sending a clear message to the financial industry that hiding behind complex jargon would offer zero immunity from severe criminal penalties. Despite high-profile prosecutions, the core deceptive structure has adapted to the digital age. Contemporary fraudsters have repurposed the prime bank narrative for modern audiences, substituting secret banknotes with proprietary cryptocurrency algorithms, decentralized yield farms, or algorithmic trading bots. Though the underlying technology claims to be revolutionary, the psychological trap remains identical: secret access, guaranteed yields, and zero risk. Recognizing these recurring patterns requires analyzing specific operational characteristics. Any opportunity promising extraordinary returns alongside non-disclosure demands should raise immediate alarms. Promises that capital is completely insulated from market risk through secret institutional mechanisms are direct indicators of financial deception. Legitimate financial markets balance yield against risk. Absolute safety combined with high returns is economically impossible. Modern financial institutions have implemented rigorous anti-money laundering and know-your-customer protocols designed to catch these transactions early. Automated systems flag transactions containing high-risk phrases or unusual wire destinations. Compliance officers are explicitly trained to identify documents making reference to non-existent bank instruments, preventing funds from leaving account holders' hands before an investigation occurs. Empowered investors must execute independent verification before committing funds to any exclusive vehicle. Potential participants should verify that investment firms and their offerings are properly registered with official regulatory databases. Consulting independent legal counsel, unattached to the investment provider, breaks the isolation bubble that fraudsters rely on, offering crucial objective oversight. The exposure of prime bank fraud stands as a defining milestone in global financial regulation. It demonstrated how public education, international agency coordination, and aggressive legal enforcement can systematically dismantle deeply embedded deception. By exposing the fictional foundations of secret banking markets, authorities established a clear blueprint for combating complex financial scams across generations. The ultimate defense against financial deception remains informed vigilance and grounded skepticism. True economic value is created through transparent market activity, not secret institutional loopholes. When faced with claims of exclusive wealth mechanisms, questioning the underlying mechanics and demanding verifiable regulatory registration ensures that sophisticated financial illusions lose their power to deceive. New stories weekly. Stay one step ahead of the fraud. Subscribe.